Revelations from my man cave. My name's Jeff Banks, I'm from Property Portfolio Solutions, and today I brought my big whiteboard because I've got a big subject to talk about. Invariably, people talk to us and say, how do I pay off my home loan sooner? Well, it's not really that question, is how do I build equity quicker? Well, it's the same thing. So if I've got my house here, and I've got my mortgage over here, how about we put a door and some windows in our house, because it's a nice house, because we want to live there, and that I'm here paying my mortgage on a monthly basis. As the mortgage goes down and the value of the property goes up, I'm creating equity, and it's that equity that I might want to draw upon to get to my investment property, to get to my goal. Right, so how do I make this pay off quicker? Well, if we look at it from a graphical point of view, if I have a loan that's, say, 25 years long, and that I make my monthly repayments as I should over that 25-year period, it will take 25 years to pay off. But simple mathematics, if I split my repayment in half and pay it fortnightly, what I end up doing is not paying 12 monthly repayments, but 26 fortnightly repayments, meaning that I'm actually paying an extra month's payment a year. Now, if I can afford to do that, that's one very smart way to reduce our loan. Now, unfortunately, in these times of low interest rates and what have you, it brings it down marginally. Back when we had 8% interest, this X equaled 4 years, if I can write that there properly. But there's actually a better way. What we can do, most banks now will allow you to have what's called an interest offset account. And what that does, if we put all our spare cash in here, and I mean all our spare cash, the bank charges interest on the difference between the two accounts. So that if I've got a $10,000 mortgage and $1,000 sitting in my offset account, the bank only charges me interest on $9,000. Now, from a tax point of view, that's actually a good thing, because if I'm investing money in an interest-bearing deposit, now lucky if you get more than 1%, but here we go, I would have to pay tax on that. But here, because I'm saving money, I don't actually attract a taxation implication. And again, if I'm using all my spare cash in here and netting it off against here, I will actually pay off my money even quicker. And there's another way to add to that by using my credit card over here and using the non-interest period, the 55-day non-interest period, pay all my bills out of here so that I've got an extra 55 days of this reducing the amount of interest that I've got to pay before I actually pay it off, then it will reduce down even further. Here we were looking at something that might bring it down to a 16-year period at 8%. Now, with low interest rates, it doesn't work quite that well, but what it does is it increases the time that this goes down while this is going up, allowing us then to access that equity to potentially invest it in investment property. My name's Jeff Banks. I'm from Property Portfolio Solutions. Things like this allow us to make your legacy our inspiration.